Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of the video is how to buy real estate using self-directed IRA or solo 401k in the US. So here we will discuss that how to invest in real estate with your 401k funds. So discussing this, we will now go onward. Steady cash flows and capital appreciations for real estate investors, these are the two of the most appealing benefits of this long trusted asset class. There is one way to make real estate investing even more attractive, adding tax advantaged growth to the mix by investing with your retirement funds. Unfortunately, many investors, even experienced investors, believe their 401k funds can only be invested in stocks, bonds, and mutual funds. This is not true. In fact, the IRS allows you to invest your retirement funds in the dozens of other asset types, including real estate. Over the years, thousands of the interest clients have invested their retirement funds in real properties to diversify their portfolio and potentially achieve higher returns. If you want to invest in real estate with your retirement funds, you have two options at your own disposal. The first is self directed 401k, the second is self directed IRA, which is also known as SDIRA. So, each type of the investment account offers its potential benefits and the considerations. In this article, we'll break down the differences between the two, highlighting how each can be powerful tool for taking control of your retirement portfolio. So, what is the table of content and what does it contains? It contains why investment is in real estate with retirement your funds, then essential IRS rules to be aware of, self-directed IRA versus self-directed 401k for the real estate investing, how to move funds from 401k to an self-directed IRA and start investing, consider whether an SDIRA or is right for your portfolio. So why to invest in real estate with your retirement funds? Before we break down the differences between a self-directed 401k or a self-directed IRA, let's examine the benefits of investing in real estate with retirement funds. The first is diversification. Real estate often performs independently of the stock market, providing a hedge against market volatility. These investments can diversify your portfolio, reducing reliance on traditional assets like stocks and bonds. Diversification helps spread risk and can lead to more stable returns. The second is potential for high returns. Properties can generate a steady stream of rental incomes, providing consistent cash flows that can be reinvested for compound growth. Plus, real estate has the potential to appreciate over time, offering significant returns on the investment. What are the tax advantages? Real estate investors typically face two primary sources of taxable income. The first is rental income, and the second is the capital gain. In most cases, rental income is taxed as ordinary income, which can reach as high as 50% depending on your income level and state. Meanwhile, long term capital gains are taxed up to 20% federally, with state taxes adding up to 14%. Investing in real estate with retirement funds, such as those in a traditional or a Roth IRA 401k, can significantly reduce your tax burden. Tax deferred growth. Using a traditional IRA or a traditional 401k allows your real estate investment to grow tax deferred, meaning you wouldn't pay taxes on earning from your rental income or capital gains until you take distribution in the retirement. So, what is the tax free growth? Contributions to a Roth IRA or Roth 401k have already been taxed, so the qualified withdrawals during retirement are 100% tax free. So, what is the control over investments? Investing in real estate allows for greater control over your investments compared to traditional mutual funds or stocks. You can make decisions about property management improvements and the leasing strategies. And if you have a unique expertise over our real estate market, you may be able to spot undervalued properties better than the competition. So what is leveraging the opportunities? With most 401ks and IRAs, you can't take out a loan to purchase more shares of Apple and Nvidia. So, however, when investing in real estate with your retirement funds, you can take out a recourse loan to potentially amplify returns. So, what is the essential IRS rules to be aware of? Ultimately, investing in real estate with your retirement funds require careful adherence to IRS rules to ensure compliance to avoid the disqualification of your account. Here's a few key IRS rules to be aware of. The first one is the disqualification. Disqualified persons. In order to minimize conflict of the interest, certain persons are disqualified from the transacting with the IRA or the 401k. This disqualified persons include the qualified person include the account holder, their spouse, descendants, and the ascendants, parent, grandparents, children, and any entities in which they have a controlling interest. So any transactions between SDIR and or a self-directed 401k and a disqualified person is strictly prohibited and could lead to the disqualification of the entire account. So what is the prohibited transactions? Prohibited transactions are dealing that your SDIRA or a self-directed 401k cannot engage in, which include certain types of self-dealing and transactions with disqualified persons. This include but is not limited. The following steps are included: self-dealing, allowing disqualified persons, including yourself, to use the property for personal use, furnishing goods or services to the property, performing services to the property such as repairs or the management, extension or the credits, using your IRA or 401k for collateral for a personal loan. So, if we talk about the fair valuation reporting, for the IRS, the price of one share of Apple stock is is easy to determine. It is publicly traded security. The same is not true for the real estate. So the IRS requires an annual valuation of your account assets to determine proper taxation whenever a taxable event occurs. As an IRA or a 401k holder, you must enlist a qualified independent or a third party to provide an accurate fair market valuation of the property to your custodian each year. So, what is the unrelated business income tax? The unrelated business income tax is basically not related to the tax exempt purpose of the retirement account. So, we can discuss investment may be subject to the unrelated business income tax. So we can this can reach as high as 37%. So we can discuss here that it is the top income bracket. So what is the required minimum distribution? If you have a traditional SD IRA or self-directed 401k, you must begin taking required minimum distribution and starting the at the age 73. If the retirement account holds real estate, you need to plan how to take distributions. This may involve liquidating part of real estate or distributing the property in kind. What is the property management and the income? All income generated by the property must go directly into the SDIRA or 401k. Similarly, all expenses related to the property must be paid from the retirement account. So, what is self-directed IRA versus self-directed 401k for real estate investing? 401k offers higher contribution limits than IRAs. So 401ks are the way go to, right? It's not that simple. Here are three of the distinguishing features between self-directing 401k and the SDIRs to help you to make right decisions. So what are the three distinguishing features for self-directed 401k? First of all, high contribution limits. It allows individuals contribution of up to $23,000 per year or $30,500 if age is 50 or the older, with additional employer contributions possible. This makes it an attractive option for those looking to maximize their retirement saving. Then comes the participant loans. With a self-directed 401k, participants can take loans up to $50,000 or 50% of the account balance, whichever is less. Then comes complex setup and the administrations, generally more complex to establish and manage, leading or to the higher administrative cost over time. These costs include setup fees and annual fees and compliance related expenses. What is the self-directed IRA? Ease of setup and management. On the whole, SDIRAs are simpler and quicker to set up compared to the 401ks, with lower administrative cost, lower contribution limits. For tax year 2024, the traditional and the Roth IRA contributions are limited to $7,000 per year. This is significantly lower than 401k limits. No loan provision does not allow borrowing against the account, which limits the leveraging you can apply to your investment. So find our comparison table before you for a more comprehensive breakdown of the difference between two accounts. So for the first feature is eligibility. So for the self-directed IRA, the eligibility is available. It is available to anyone with the earned income. The eligibility for the self-directed 401k is that it is eligible best suited for the self-employed individuals or small business owners with no employees. The second feature is contribution limits. For the 2024, the self-directed IRA's contribution limits are $7,000 per year, 8,000 if age is 50 or older. Self-directed 401k, 23,000 per year, 30,000 and $500 if the age is 50 or above. Additional employer contributions possible. The fourth feature is third feature is setup complexity. A relatively simple and quick setup process is for the solo 401k, and for the solo IRA, the more complex setup and the administration is come under the area of setup complexity. So the fourth feature is loan provision. 401k, no loan provision is allowed. For the solo IRA, SDIRA allows loan up to $50,000 or 50% of the account balance, whichever is less. So the administrative cost typically lower, limited to record keeping fees and the transaction fees. And for the self-directed IRA, the generally higher includes setup fees, annual fees, compliance, and the administration cost. What is the compliance and reporting? Less complex minimal IRS reporting requirements, more complex annual form 5500 filing required for the plan over $250,000 in assets. What if you're self-employed or a small business owner and want the higher contribution limits of 401k without administrative cost? You might benefit from a self-directed SCP or a simple SDIRA. How to move your funds from a 401k to an SDIRA and start investing? Moving your funds to an SDIRA from 401k and investing in real estate can be done in 5 simple steps. So the first step is to open your SDIRA. Select a reputable provider like the Interest Group with decades of experience and expertise in the SDIRA industry. And Interest All you need is to open an account is 10 minutes of your time and a copy of the government issued ID. So the second step is to fund the account with a rollover. If your 401k funds are with a previous employer, completing a rollover is simple. A direct rollover ensures that funds are transferred directly from an old 401k to your SDIRA without taking possession of the funds. This method helps avoid any potential taxes and penalties. The third step is to identify and evaluate real estate investments. Look for the properties that fit your investment criteria, whether you are seeking residential, commercial, rental properties, or raw lands. Perform through the due diligence, and this includes evaluating the location, market condition, or the potential rental income, property condition, and any legal issue. The fourth step is direct interest to purchase the property. Once you've chosen the property, you need to instruct the interest group to make the investment by submitting a real estate by direction letter. You can do this with a paper form or through the interest client portal. Then we will complete the purchase on behalf of your SDIRA. What is how the fifth step is to manage the investment. To decide whether to manage the property yourself or hire a property manager company. Keep in mind that as an account holder, you cannot personally perform repairs or the renovations. So, what to do if your 401k funds are with your current employer? If a majority of your 401k funds are with your current employer, you may still be able to complete a rollover to an SDIRA. Some employers allow in service withdrawals which permit you to roll over a portion of your 401k funds to an IRA while still employed. This is not available in all plans, so you must check with the your plan administrator. If your employer does not allow in service withdrawals, you will likely to have wait until you leave the your current employer. Only then can you be able to roll over the 401k funds to an SDIRA for smoother process. Opt for a direct rollover to avoid withholding taxes and ensure compliance with the IRS rules. So consider whether an SDIRA is right for you, for your portfolio. Investing in a real estate with your retirement funds offer many advantages, including diversifications, potential for higher returns, and enhanced control for your portfolio. Whether using an SDIRA or a self-directed 401k, understanding the IRS rules and following the correct steps will help you make the most of this strategy. Have more questions about SDIRA? You have to download the our SDIRA basics guide. Inside we've included a more comprehensive breakdown, the IRS rules, examples of what you can and cannot invest in, and a step by step process to get started on. If you want specific stories from interest client, you who have invested their retirement funds in real estate, check out the recent client stories from Christy Selle and the Carl Kaplan. So we have discussed in this article that what is the best self-directed solo 401k or the self-directed IRA, how to invest in the real estate with your 401k plans. So when we talk about this steady cash flow and capital appreciation for real estate investors, the two of the most appealing benefits of this long trusted asset class. There's one way to make real estate investing even more attractive. So that was all about the topic, and here we discussed what is the real estate investment, and how you can use the invest your money in via using solo 401k or a solo IRA. Hope this topic will have been beneficial for you. So do subscribe the channel for more helpful videos. Thank you so much.